Hello and welcome. You're watching KYC. I'm Harsh Saita, and today we're going to be talking on a lender in the small finance bank space. And it's an interesting play because you've got a decent amount of growth. Credit costs are not that high for this one, and it doesn't have any direct exposure to microfinance, and that's why this one kind of stood out for me. Let's pull up what I want to know first on Capital Small Finance Bank. It's a recent listing, of course, but outside of that, you're looking at them having exposure in the NBFCs and MFI segment, but indirect exposure, not direct exposure. And in terms of the credit cost, at 0.4%, which is their credit cost in Q1 FY26, it doesn't look too elevated or too bad. And out of that, half of the credit cost is emanating from here, and there could be a possible positive surprise to that number because you will start to likely see recoveries come through. And I'd want to get a sense. I'm not sure how much of a sense we'll get, but it'll be an important metric. And frankly, that credit cost number of sub 0.5% for a small finance bank is what really attracted me to this one. So we'll get more details on the sustainability of that as well. Though some of those thoughts will also be important. Now let's talk about the Agri book in particular. Now, Agri loan book growth and overall loan book growth is going to be very, very crucial going forward because Agri is the largest part of their book. That's one. Second is the book size is not too large. So you're seeing a relatively smaller size, sub 7,500 crore kind of size bank with a very strong possibility of growth. And that's what really also stands out for me. So some color around growth. One piece which has been a bit of a concern, they've guided for growth of 20%, but they've not achieved it, especially in FY25. So I'd want to, that's why this metric is important for me, to try and understand whether they can clock that kind of growth. The third piece is with regard to geographic concentration. They're concentrated in a Punjab and a Haryana. Now they've guided that they will diversify. They'll probably diversify into a new state, and that will also be a new growth lever. But along with it comes its set of risks. So what are they doing with regard to geographic concentration? And this, to me, is one of the largest risks that this bank faces, because they have a good pulse on Punjab, Haryana. But what outside of that? And they're present in 5 states outside of that as well. But it's a very, very tight geography that they operate in. Fourth lever, of course, is deposit growth, and that hasn't impressed me as much. So what are they doing in order to try and go in and build a liability franchise? What are the geographies they're looking at, and what are the measures that they are taking? Margin stability, can it sustain? It's been fairly stable and robust. The question, of course, will always be on whether it can sustain or not. And the liability franchise will, to some extent, also drive the kind of margins that you will likely see in terms of comfort. Now let me talk about loan mix and credit cost expectations. In terms of the loan mix itself, I'd want to know if that might change given a change in state, and whether this 0.4% kind of credit cost number that we're seeing is something that can be controlled and contained to that extent. Last piece, of course, will be the NPA ratios, and the NPA ratios have been in that band of 2.5% plus on the gross side, and on the net side as well, they've missed some of their estimates, and they've given reasons which would suggest that they're trying to calibrate ROA to ensure that the ROA sustenance remains. But at the same time, it's very, very important to also understand where the NPA ratios lie on a steady state basis. Can they improve along with that steady state ROA? So all of those is what we will try to get to. NPA ratio is nothing, the net NPA ratio is nothing, but it's the provision you make on the bad loans that you have, and what is the residual loan balance of bad loans that you still have post the provisioning. So that kind of explains it, and ROA is obviously the metric of profitability where banks are concerned. Now let's talk about the bank itself, and it's India's one of the first small finance banks of India. It was founded in 1999, got a small finance bank license in 2016, It's got a strong presence in Punjab and is expanding across northern India. It generally focuses on secured loans, and India's middle income segment is what it focuses on. Nearly all the loans are secured. There's very low bad loans per se, and it's retail deposit focused. It has a decent CASA as well. So broadly, that's how it plays out. That's the sum and substance. Let's talk about the background. It was founded by Mr. Sarvjit Singh Samra and some of his associates, colleagues. Started as a local area bank in Jalandhar, Punjab in 1999. Thereafter expanded 47 branches to 195 branches. Now operates out of 5 states and 2 union territories. And it's built by, of course, a core founding team, as is evident. And of course, the MD CEO continues to be Mr. Samra. How is it built? Well, it's focused on middle income, rural, semi-rural customers, and it does secured lending. Well, it also listed on exchanges in February of 2024, where they did a capital raise through an IPO. And of course, that is something that we need to also highlight. Let's talk about products, and around 7,500 crore being the book size, but Agri loans is the largest chunk, 30%. It's crop, farm equipment and Kisan credit cards. That's how Agri loans is built. On the mortgage loan side, as would be understood, it's regular home loans and loans against property. 27% is the mix where mortgage loans is concerned. Then there is MSME loans, which is working capital, business, project finance for SMEs. That also is something that they lend to. Around 22% of the loan book goes there. You have around 14% loan book sitting in corporate, which is NBFCs and microfinance. Now, this is an indirect set of loans that they've given. So it's not a direct microfinance lending. It's to microfinance lenders who have onward lent. Now, the problem could happen if the microfinance lenders default, which is NBFCs actually default on the loans given by Capital Small Finance Bank. But this, again, in terms of book size, is just 14% of the total book size. So when you're talking about 14%, it's probably 1,000 crore odd in terms of book size out of the 7,500 crore of total cumulative loan book that they have. Now let's talk about consumer and other loans. Around 7% is that personal, auto, gold and loan against deposits. So that's how it really stacks up in terms of where it lends to. Now let's talk about the metrics, as we always do. We'll start off with the income statement, the balance sheet. We won't have the cash flow, as is evident for lenders, but operational metrics and asset quality is what we will focus on. Thereafter, we will look at shareholding, street cred, street coverage, and we will look at valuations. Excuse me. And we'll sum it up with all of those 8, and we will speak with the management and get better clarity on what they expect on this one. So let me start off with the income statement, and it's a decent looking income statement. You're looking at 70% growth on the net interest income front. Operating profit has also grown by around the same similar kind of region. We're looking at provisioning, which hasn't really spiked in any significant fashion. So you're seeing very low CAGR there, and that's what's aiding profitability. 25% plus profit growth. There's no concern per se here to talk about, and therefore we've given this a thumbs up. And as you would also see, really no complaints. But let's talk about the balance sheet. Now, in terms of the size, it's at around 7,200 crore at the end of FY25. What you would want from a small finance bank, which is sub 5,000 crore, say at the end of FY22, would be to grow fast, right? But that's not happened. They've grown just about at 15%. Some of its peers obviously grow much faster than that, and there are some peers which don't, but a predominant set of peers would typically have grown faster than that. And that's where this one really stands out, that kind of alpha in terms of growth isn't getting delivered and isn't visible. And that is also visible in the deposits. And the credit to deposit ratio is quite healthy in that sense. So that's the other piece which really stands out for me. Around 3,080 odd crore in CASA, around 25%. So the CASA ratio is actually inched up. And the capital adequacy also is fairly decent at around 25% post this equity raise that they've done. So that should give you a good runway of growth and less equity dilution, hopefully, if the asset quality remains quite sustained and controlled. So those are some of the aspects that you'd want to look out for. CASA growth of 7%, well, not really impressive, but it's also been a tough growth environment. But 11% deposit growth on an 8,000 crore base, am I impressed? Well, maybe not entirely. And advances growth of just about 15% on a book size of 7,000 crore, well, again, not exactly impressed. But if some of those numbers could change, that's when you could start to see some alpha play out all of a sudden as a result of that. So again, something to bear in mind where Capital Small Finance Bank and the balance sheet is concerned, that you might well see, if at all, that there is solid growth, that these numbers would change. So you want to keep your eye out on that one. Now let's talk about the operational metrics. And when you're looking at the yields, they've been fairly stable across the board. You've also got cost of deposits. Let's pull those up. You've seen an inch up with regard to cost of deposits. But when you're looking at margins, you're seeing a fair bit of stability where the margins is concerned. So the cost of deposits also, the inch up hasn't been as sharp, and therefore they've been able to somewhere control the margin levers that they have seem to be quite reasonable, because you look at that margin number, 3.8 to 4.2 is not a very bad band to be in terms of margin. Sometimes in tough margin environments, you see some of these smaller banks really slip badly, which doesn't seem to happen where a Capital Small Finance Bank last 5-year record is concerned. Now let's talk about the cost to income ratio. This has remained extremely elevated, 60% plus. So this is where you're seeing some bit of weight when it comes to profitability. And when you're seeing your ROAs, you've seen them largely bunched up between 1 to 1.4%. This is on average assets. And if you're looking at the average advances that they've disbursed, then it's a 1.6 to 2.1%, which is quite decent, which is not bad at all when you're looking at it in the overall scheme of things. Because on the advances book, you've got around a 2% ROA. But of course, on the AUM as a whole, you might have a lower, more compressed ROA number. So can that expand? Is there a lever for expansion? And how can we expect that, or how can we expect profitability to rise, is something that you would want to keep your eye out on. This 25% growth that they've seen over the last few years, is that sustainable, is the other piece. Now let me talk about asset quality. And when you're looking at the NPA ratios, and we'll quickly pull them up, you largely see them between the gross NPAs between 2.5 and 2.8. The stability is what I give them a thumbs up for. It's very, very stable. The net NPA number also between 1.3 and 1.4. So it's a very tight band in which they operate, both on the gross and the net NPA. The aspiration is to bring down the net NPA to 1% or maybe even below that. But I believe that could take some bit of time, because they're calibrating ROA, as I did mention, because of these ratios. Let's talk about shareholding pattern. 19% promoter owned, fairly no big changes, because since listing, it's not been too long since listing, and therefore don't see that as something that will change. FI ownership has been rather steady. The DI ownership too has been rather steady. No concerns with regard to shareholding, only that it's below 20% from a promoter perspective, and therefore we've given this a neutral. No other concerns per se from a shareholding perspective. So again, something you want to keep in your mind. When you're looking at street cred, you look at the 1-month returns, the 6-month returns, the 1-year returns. It's been fairly flat. Nothing much in terms of major moves. Since the IPO, the stock is down 37%. And since listing, it is down 31%. So what you could well start to see is that where stock returns are concerned, it's not been very good for investors. And that's why I've given this a thumbs down. But for investors considering a possible study of the bank, you also want to know that it's not given any returns to investors, and therefore maybe you want to go back to first principles, understand, and try and figure out as to whether there could be a positive upside here going forward. Now, in terms of the street view, well, you've hardly got 2 analysts with a buy rating. 29% return potential, but because there are only 2 analysts, we've given this a neutral, just from a conservativeness standpoint. And let's look at the valuations. The valuations don't look expensive at this point. We've repeated this a couple of times. We've done a couple of pieces with regard to small finance bank if you've been tracking NDTV Profit. And what you're seeing in terms of valuations is not very expensive either. So you've got a decent price to book that it's trading at, which is just about sub 1 time trailing 12 months. And you've got some of the peers trading in around it. So it's not exactly very, very cheap, but doesn't look very, very expensive either compared to peers. Of course, that's the key. Now let's stack up the ratings, and you've got the income statement, the balance sheet. We've given a neutral because of growth. Operational metrics, a thumbs up we've given. Asset quality, again a neutral. Shareholding, neutral. Street cred is the one piece where we've given it a thumbs down. Of course, it's not in the management's hands, but post listing, it's really done nothing. Street coverage is a neutral, and valuations is also a neutral, given the way all of the small finance banks are currently placed on a price to book basis, giving it a final rating of 4.5 on 8. Now let me go across. We have Munish Jain, Executive Director at Capital Small Finance Bank, joining us. Sir, it's great having you. I want to first talk about the Q1 numbers, and as part of the Q1 numbers, NBFCs which have lent to MFIs have faced some heat. Do you expect that to reverse in Q2 for you also? And you've obviously, the credit cost number is just 0.2% for you, but I'm just trying to understand how quickly does that unwind, because that will mean that your credit cost is virtually one of the best in the industry. So does that unwind in Q2, you suppose, or we'll have to wait for Q3? And what will the Q2 larger, what's the larger picture looking like in Q2?
First of all, good morning, and thanks for me for the show.
Thank you.
As far as NBFC MFI pie is concerned, statistically, NBFC MFI pie is constituting less than 1% of our portfolio. We have 14% portfolio to the NBFCs, and out of this, MFI pie is less than 1%. So we have almost insignificant pie, and within this pie, we are typically more than 55% is A plus rated NBFC MFI. So with that thing in sight, we are not presently seeing any negative surprise coming ahead in the period to come. Yes, we have seen one of the slippage, some slippage in the Q1, but Q2 from that standpoint, or I will say from the going forward also, we are not looking forward for any negative surprise. Just positive surprises may come on this side. So that is regarding this particular pie is concerned. And regarding our philosophy, we being a retail-centric, middle-income group-centric entity and a secured franchise. And that is the same philosophy we follow when we do the corporate lending. In the NBFC, we will typically lend to those NBFC who are lending to the secured pie of the customer. So which is giving us better comfort and lesser volatility on the asset quality side as you move forward, including the present scenarios.
Got it. Understood. So what about the rest of the book? I'm just trying to understand what helps you keep the credit cost so low. Not seen it much across the industry. And would the NPA numbers have any role to play in that? In the sense, are you more comfortable with keeping the gross NPA at maybe 2.8 and the net NPA also closer to 1.5? Is there a reason for that, a rationale for that? Give us that perspective.
Typically, before that, I just like to clarify a couple of things. We as an SFB have identified a niche of the middle income group customer segment as our target. If you look into our ATS of the asset, this being around 60 lakhs. Secondly, we are a secure lender with 99% plus of our book being a secured. And with 80% plus of our book, we have a collateral in the shape of the immovable property or the bank FTR of the value of amount more than the loan. So, and we are a production lender. Over 80 to 85% plus book is lending to the customer which generate cash flow for them. So these are the basic 3 principles on which we typically lend to. So with these 3 principles in lend, and our asset composition look like we have 30% agriculture, we have 27% mortgage, we have 22% MSME. And being a secured franchise,
But sir, apologies, I'm interrupting. But sir, there are a lot of lenders who do that. You know, we've heard arguments from several lenders which say that we are very, very cash flow linked. But they're all seeing pain in their books. So I'm trying to understand, what is it that helps you stand out? What's the formula?
so typically, as I said, we typically a cash flow based lender. The slippage ratio being a retail franchise is always remain there. Our gross slippage ratio historically remain in the range of 1.5% to 2.25%. But our strength lies in minimizing the net slippage. If you look into any of the year, you will find the upgrade versus recovery from the existing NPAs are almost nearer to the gross slippage. So which is helping us in keeping the gross NPA in control. If statistically, you rightly said, our GNPA remain in the tight range of 2.4% to 2.75% range. And we intend to bring it down to 2.2 to 2.3% as we move forward. Our net NPA, which remain in the range of 1.2 to 1.35 or 1.4%, we intend to bring it down as in a medium term basis to around 1%. And we are typically, if you look into historically, a few more important points. Historically, we have around 0% write-off, and we have not and we have not sold the NPA with the haircuts to at any point of time. So typically, the number which we're talking is purely recovery effort based, rather than after exercising some balance sheet cleansing activity. So which is giving us a comfort. This being a secured franchise, having an immovable property of the value more than amount of loan, there may be a time gap available, but typically we are able to recover what we lent. So
Understood.
that's the reason we're comforting for the credit cost rate.
Understood. What brings down the NPA ratio, sir? What is the lever that you have? Is it going to be recoveries? Is it going to be growth? What's it going to be?
It will be the combination of recovery and the growth.
Understood.
So,
and what's the growth direction going to be like? You've guided 20% in FY25. You fell a little bit short. So just trying to understand what's the certainty of that 20% plus kind of growth in an environment where growth has anyway come off. So give us that perspective.
last year, yes, we were targeting 20% growth in the beginning of the year, but industry segment perspective, the growth has sharply pulled down. But despite that fact, we are able to grow typically 1.7x of the industry growth in the last fiscal. Current year, again, we are targeting to grow. Now we are targeting, and we are rather more confident of growing the balance sheet for the current fiscal of 20% plus, and intending to improve our growth rate as we move forward. Given we being a MIG guy, we believe the opportunity available in the MIG segment, which is both in the count and the ATS number, average ticket size, there is significant available. And the type of the segment we are there in and the product we are in, we see a good momentum picking up. And that's the reason which is gives us a confidence, further confidence, that we intend to grow 20% in FY26 and continue to enhance our growth rate as we move forward on the advanced side.
Is there a target, sir, in terms of ROA? Because your ROA, again, has been one of those numbers which have been very, very steady. So I'm trying to understand, is there a target here? And as you scale, does this also go up? Because your cost to income remains elevated. I'm trying to understand, for how long do you do that OPEX? For how long does it remain elevated? You're a relatively small bank. Is that something that we can expect to remain steady state for a long period of time? And therefore, what's the ROA number?
We are, as you rightly said, we are continuously improving a ROA, which is 1.4 in FY25. The same was 0.9 in FY22. So for each of the fiscal from FY22 to 25, we continuously increase the ROA. We intend to maintain the ROA around the same level for the coming 3 quarters for the current fiscal, given the sharp interest rate reduction and the consequent impact on the margin which may come. But medium term basis, we see a constant and continuous expansion in the ROTA. So there are multiple levers available in the present balance sheet. One lever.
So despite this pressure, ROA won't fall, sir? Is that the right? Am I hearing it right?
Yes, we are intending to maintain the ROA for the next 3 quarters jointly. That is what we are targeting.
At what? At 1.4%, sir? Is that
around 1.4% levels?
Understood.
Plus minus 0.5%. 0.05.
So you should exit FY26 at around anything between 1.3 to 1.4. Is that?
Yes.
Is that
yes.
okay? Okay.
Yes.
Understood. Fair point, sir. Got it. Sir, last off, just trying to understand, what are you doing in terms of deposit growth? Because that number was has been just about 11% last 3-year CAGR. Is that a concern for you at all? Because you're a relatively smaller bank. So just trying to understand what are you doing about that?
If we look into the deposit side, June period, we grow year-on-year basis by 18%. Last year, we were anticipating a sharper interest rate cuts. So we were calibrated over deposit growth. In Q1, after the 2 rate cuts has come, we have put a paddle on the deposit, and Q1, we grow the deposit by 9.5%, quarter-on-quarter basis. And effectively, year-on-year June, we are 18% plus deposit growth for the organization as a whole. And we continue to be retail-centric. Historically, we are 90% plus retail-centric deposit, with a cost of deposit of sub-6, with a CASA of 35% plus historically. So I will say we are having a lot of levers available on the deposit side, and given a lower CD ratio, over average CD ratio typically remains around 80 to 82%. So we have calibrated the deposit growth to support the advance growth. So, but we believe we have strong capabilities given our history and given our strength of being a middle income group customer centric, and purely ATS of our saving is 43. ACF of deposit is around 10 lakhs. So with that granularity in approach, which is giving us a higher confidence to continue to grow deposit to support the growth which we need on the advance side.
Okay, sir, thank you so much. You've come in, you've given us quite a bit in terms of food for thought, and thank you for coming in and candidly answering all those questions. And folks, that's all actually from us here from the KYC team. And KYC, of course, only on NDTV Profit. And we hope that you too found this profitable because it's for your profit. Thank you so much for joining.